here's the last, at least the main thing for us today, and that is how to come up for, and as I said, this was kind of placed funny. I'll move that next time around. Accounts receivable. You've got to come up, using the allowance method, we've got to come up with a technique that we can use to reliably estimate the amount of uncollectible accounts. We have two methods to do that under the allowance method. Under the allowance method, we have two techniques. Both will trade off a balance sheet focus and an income statement focus. We've got a balance sheet approach and an income statement approach. The balance sheet approach or balance sheet focus is either using an aging of accounts receivable or a percentage of receivables to estimate the amount that will not be collected. Or we can use a percentage of sales. Now, here's the difference. And this is something, I know, Dwayne, we were talking about that a little bit before class. You tried one of these. Got to be real careful with the focus, because when you use the aging of accounts receivable or a percentage of receivables, I am telling you what you need in this account, what balance you have to have. It doesn't mean that that's the adjustment. And I'm going to show you some numbers in a second. So what we do with the balance sheet focus, my concern is the allowance account, my concern is net realizable value, and I don't care what happens to the expense. The expense is a byproduct, because once I find the number I need to bring this account to my target balance, it forces the expense. On the other side, if I focus on the expense and take a percentage of revenue, then I get the expense I want, I satisfy matching, but I don't necessarily get the realizable value that I should have on my balance sheet. So you're going to be trading off income statement matching with balance sheet valuation. So the balance sheet approaches focus on proper balance sheet measurement of net realizable value, whereas the income statement approaches focus on the matching and less on the balance sheet. Now, in practice, of course, the trade-off doesn't really exist as much because there's a lot more that goes into it. We're going to read a footnote, I believe, from Target or Hewlett-Packard, and you're going to see a lot more goes into this than just flat percentages. In fact, under IFRS, they will really make flat percentages your last choice. So it pretty much focuses or operates that way as well. Now let me show you matching. Let me give you an example. An aging rather. Here's an age trial balance. So in an age trial balance, you might have even seen this if you open up your next doctor's bill or something from the dentist on the bottom. You'll see they'll say current, 30 days, 60 days, 90 days. They're actually aging your receivable. So what we would do, and this is, again, I'm sure the world has changed significantly with data analytics, where we could, quickly come up with this information. But now, at least from my experience, we still will use these agings. So what I would do is I'd look at my first company, Bronxon. They've got a current at 800. This fraternity has a 2100 current. Andrews and Jones are up in the 31 to 60 day category. Perez has a current account. Thompson and Clark, they have a 60. Thompson 1.2, 60 day overdue, 90 days overdue is going to be 100 for Clark. Now, we would do a total. We would also do a specific review of individual accounts. So what my manager or partner would probably tell me to do, or when I was kind of in supervisory roles, I would tell the staff, we've got to look at these two accounts. And what I mean by look at them, we have to look at them very carefully, try to get their financials if possible to see what their probability of paying is. In other cases, some of my clients, if they were over 90 days past due, they would send them out to the attorney and just write them off. They would send them out for collection immediately once they hit the 90-day past due. But in our textbook world, let's assume we're not doing a specific review. As you would expect, as you go further along in the aging, as the accounts get older, they become less likely to be collected. And therefore, you take a larger percentage against that account. You might, say, well, you know what, I'm not even going to take anything against the current accounts, but you always do something. I had a manager once tell us that we had guaranteed receivables from the government, and we still took an allowance. We still took a small allowance against that, just to be conservative. So, 1%, $42. 2% of the second aging category, 17. 61 to 90, 3%, and then you'd either take 100% or a very high percentage of the over 90, and we add this up. This is the target balance. What that means, when you use a balance sheet approach, and by the way, I could use a percentage of the total. I could take a total receivable and take 1% against that, but that's my target balance. What that means is, in the allowance account, that's what I want to have in that account. That's not my adjustment. Make sure, if you still need more coffee, just take a deep breath and make sure you understand that that target balance is not the adjustment. That does not go into your adjustment. That is what I have to have. Now, that will depend on what? What's in here already. What if I have $185 in there now? What's my adjustment? I got 185 in there already. What's my adjustment?
0.
Nothing. You don't need anything. You've already covered the allowance. So what I'm saying here is that, look, I got 185. My aging tells me I need 185. No expense, so I have no matching. I've got no expense, so I force that expense, but I got the balance I want. Now, I'm going to give you some other variations here. Again, using the target. Can I use the same slide? Yeah, I will. Okay. So let's assume, let's take one case. Case A. And in case A, my balance here is 100. And my accounts receivable, by the way, are 63.75. Okay, so we're going to do like an exercise right now. All right, I got a balance of 100. Somebody in your audit team does an analysis of aging, walks in and says, look, we need 185 in that account. There's 100 in there already. What's my adjustment? $85. So I'm going to debit the bad debt expense, and I'm going to credit the allowance for 85. Because the target balance is what I need. I already have an existing credit balance of 100. I only need another 85. Let me give you another. Let's assume, and by the way, this allowance could have a debit balance. Case B. Somebody in the staff comes in and says, look, you need 185 in that account. The account has a debit balance of 100. What's my adjustment? 285. Same aging, same accounts, different adjusting entry, same net realizable value.
Was what was already in the allowance, had that already been expensed?
Yeah.
Oh.
Oh, yeah. Don't forget, the balance sheet accounts, and these are good questions, because when you first look at accounting, you have to realize that balance sheet accounts are cumulative. So you could have balances left over from last year. Now, how do you have a debit balance? We'll talk about that. We'll show you how that works. But basically, with this allowance approach, you always have to think about or the balance sheet approach, I should say, you'd have to look at the target balance, you're going to add an existing debit balance or subtract an existing credit balance. And that's the amount of the adjustment. So, in the first case, it's the other way around, actually. That's the other way, so here's my research. Okay, just switch these, so I'm going to put them back in order. First case, there was a credit balance left over from last year, so you only need 85. Second year, there was a debit balance, got to add that, and your adjustment is 280. So balance sheet approaches, the aging and the percentage of receivables will work that way. So the balance sheet approaches creates a target balance or a desired balance. If you have a debit balance in there already, you got to remove the debit balance and get the target balance in there. If it has a credit balance, you only need the residual or the difference.
What's the adjusting entry if you have to debit the allowance account?
When you have a write-off, we're going to show you that. All right, so questions on our first example. And as I said, audit analytics would pop up all kinds of exceptions out of here very easily. It'd be very easy to do that. Let me show you another one. Here's another agent. And this time we don't have all of the customers' accounts listed. So in this case, you've got 98.2 of receivables, and you expect that the uncollectible accounts will be 37. We'll play with this a little bit more in a few minutes. But I just want to let you know that the aging is really applying percentages against specific categories. I mean, if I took, for example, what I could do, there's another method. This is called the aging method. The other method is called the percentage of accounts receivable. So this comes out to something like 3.126%, I think, yeah. So this could be implemented in one of two ways. I could say, I'm going to give you the aging categories and give you a list of those percentages, or I could give you a flat percentage of all the receivables. It's the same process with the target balance, but it's done a little bit differently. One takes into account separate categories and puts more weight on the older receivables. The other will take a flat percentage against all the receivables. So in some cases, in a textbook world, or even in practice, since we're combining so many, as we'll see, we combine so many different methods that this could just be a baseline. And rather than go through the aging, of course, companies will go through an aging, but just as a first pass, maybe during a quarterly review, as a first pass, you may take a flat percentage against all your receivables. It's really the same process or the same theory, except that the process is different. So rather than taking percentages of all the receivables, you take that percentage against the individual categories. Now, those are known as the balance sheet approaches, the aging or the percentage of receivables. Now, the other approach, now those are the balance sheet approaches. The balance sheet approaches emphasize net realizable value and force the expense. Right? You should notice that the expense was what? 85 in the first case, 285 in the second case. The extreme case I gave you to start off with is that you already had 185 in there. You didn't need anything. So it really depends on the balance when you use the balance sheet approach. The next approach, and we use some different numbers in here, is going to be the percentage of sales. The percentage of sales is an income statement model. And let's say that, let's take the same ideas we had before. Percentage of sales. So let's say you sell 156,000. And remember, be very, very careful on homework or exams. These are credit sales. So what if your company sells both on cash and credit? You only provide an allowance against what? Credit sales. So cash sales will not matter. So these are credit sales. And I'll add a little bit more to this after the break as well. But 2.3 is my estimated amount from past years. I believe that based on past experience, 2.3% of credit sales go bad. That becomes the bad debt expense. So in this case, if I have a balance in here, let's say I have a balance of 100, what journal entry do I make? I don't have a target balance. I don't really care about the balance of the allowance account. In this case, I don't care about it as much as what? Matching. So here, I've got $3,588,000. I debit the bad debt expense, I credit the accounts receivable. And now the allowance account has a balance of $3,688,000. If the balance before was zero, if the balance before was $1 million, doesn't matter. You debit the bad debt expense, you credit the allowance for the percentage of sales. Another example. What would happen if I had a debit balance in there? That entry doesn't change. What is on the balance sheet does not affect the adjusting entry. So what happens is that when you use the percentage of sales approach, it is a income statement focus. I'm only worried, and my main concern is to get the bad debt expense at $3,588. The resulting balance in the allowance for bad debts is secondary. It's forced. That balance is forced. Now, of course, in practice, you're going to combine lots of different approaches. We're going to see some journal entries now in a minute. But the bad debt expense is going to match with the credit sales for the year, not necessarily going to give you the balance that you would want. Now, it is easier, of course, than the aging, but it assigns, in a sense, it's less accurate from a balance sheet perspective because it assigns the same amount regardless of the balance of the allowance for bad debts. All right, so we're going to go through, so those are the methods. Balance sheet focus, income statement focus. We're going to go through two examples. And I'm going to finish one now, and then we'll take a break. And then when we come back, I'm going to go through the more comprehensive. So let's go through another example. And this is going to be credit sales of $560. We know that when we have credit sales, and again, as I said for the exam, you're going to start to kind of get away from the equation. If you want to use it as a guide, you could. But I'm just worried about the entry. So if you book sales, You're going to debit accounts receivable and credit sales. So you got 560 in the revenue account, 560 in accounts receivable. So let me actually put these over here. So I'm going to put that in our accounts receivable account. And I'm not going to worry about the sales number right now. So we debit accounts receivable and we credit sales. Now, at the end of the year, by the way, this should be, this should be 560. This should be 560 here. Okay? So the 560 is the receivable balance. I think I corrected that. I just didn't load up the right slides here. It should be on Blackboard, should have the correct amount, but just cross that out for now. That should be 560. So the 560 receivable balance, based on aging, they determined that the uncollectible accounts should be 370. So now there's no balance in the allowance for bad debts. So we're going to, there is no opening balance. So the beginning balance is 0. And the target balance is 3070, so that the adjustment has to be 3070 based on aging. So the entry is going to debit the bad debt expense, credits the allowance for bad debts, and again, the net realizable value in this case is going to be 556,930. Difference between the two. So that's your net realizable value, 556,930. Now, if, because this was a balance sheet approach, if there was $100 in that balance already, that would have reduced this to $29.70. If there was a debit balance of $200, the adjustment would have been $32.70. So depending on the balance, since this was a balance sheet approach, our main concern is to get this net realizable value at 566,930. Now, question I know that Steve had a few minutes ago is how do you get a debit balance in the allowance for bad debts? You will write off, as they become known to you, you will write off bad accounts against the allowance. The allowance becomes a cushion or provision. The expense occurs in the year of the sale. It does not occur when the account goes bad. When the account goes bad, when you find out that a particular customer is not going to pay, it is going to be charged against the allowance. The allowance becomes your reserve for bad debts. That is going to be used to absorb losses. No additional expenses are charged in the year the account is uncollectible. So if these accounts become uncollectible 2 years from now, there's no additional expense. The expense is already charged in the year of the sale. So let's take a look at the account. Let's assume that next year the company determines that $2,100 of those receivables are not going to be collected. Those are specific accounts. So you know it's customer ABC. ABC company is not going to pay. You write off the account against the allowance. If you look at the equation, in this case, there is absolutely no effect on revenues, expenses, net income, or earned capital or retained earnings. The entry is a debit to the allowance account and a credit to accounts receivable. You write the account off against the allowance. There is no expense on the write-off. So after the write-off would then, and I have it here anyway, but I'll show you, you're going to now write the account off, 2,100. The balance is 970 in that account. And you wrote the receivable off also, and that balance is 5,579. You have it up on the screen, but that's the results. Now, when you write off an account, it is not an expense. You write it off against the allowance. The allowance is a cushion or a provision against which you will write off your bad debts. And the accounts receivable is a specific account that you remove from the ledger. Now, the balance can become a debit balance. If you write off more than you provide, you can wind up with a debit balance in the allowance for bad debts. And that can happen. It'll just be adjusted at year end. But during the year, like if you have to make an adjusting entry at the end of July, that balance could be negative. So the balance could be negative if you have excessive write-offs, meaning you write off more than you provided for in the previous period. You do not expense. Even if you have to debit the allowance, you do not expense it. When would that expense actually manifest itself? If you underprovided in 2016 and you start writing off lots of accounts in 2017, that would give you a debit balance in 2017. When would the additional expense manifest itself?
It would be taken out of retained earnings when you took it out of accounts receivables. I mean, not retained earnings, revenue.
Well, it will hit expense somehow. It's going to be the next time you adjust. The next time you make your adjusting entry, particularly that's why we like the balance sheet method, because if I see a debit balance in there, I've got to get rid of the debit balance and then provide an allowance. And that raises the expense. So once again, what does it do? And let me get back to your point earlier on the percentage of completion. What you're going to see, and going forward into intermediate accounting, you're going to start to see the same pattern over and over again. And we just established a pattern today. If you made a mistake in estimating percentage of completion on contracts, that mistake or error is uncovered next year. You make the correction and you go forward. You don't change prior periods. It's a change in estimate. What happens if you make a mistake in estimating bad debts? Same thing. The year you discover the error is the year you make the correction and affects that year's earnings. You don't go back and change 2016. So if I've got a debit balance in 2017 because I wrote off too many accounts because I didn't provide enough in 2016, the catch-up is the next year. So the expense gets shifted, yes, but it's a perspective or a change in estimate. Exactly the same model we had with the change in estimate. Now, one last point before we break, and then we'll come back for an extensive or a little bit more detail. You notice I did not change net realizable value. I didn't forget to do that. It's because the net realizable value is unchanged by a write-off. The write-off does not change the net realizable value. So that the net realizable value stays the same before and after the write-off. Because again, you're writing off exactly the same amount of the receivable as you are against that allowance account. So the allowance account is reduced by 2,100. So are the receivables. Those accounts are reduced by the same amount, and the net realizable value does not change. The net realizable value will not change. You have fewer receivables, and you have less in that allowance account. So in this example, we've got accounts receivable with a balance. Of course, it should have a debit balance of 180. And as we said, you could have an allowance with a debit balance as well. You have to be very careful. This is a debit balance of 3.5. And that means that you underestimated your write-offs last year, and therefore you're shifting income. Those slides come later. We've already covered those. You don't have to worry about that. We've covered the idea that now you're going to have to possibly make up for that underestimation. this period. We also have sales on credit, 1,360,000 and 60 sales returns and allowances. We're going to use net credit sales, but I just want to let you know that you could see a sales returns and allowance. Sales returns we talked about today. You could return some of those products. An allowance is where you don't return the product, but you get credit for or a reduction of your price. Something happens. Something gets delivered, it's scratched, you take a picture, delivery people go back, say, yeah, we're going to give you $60 off or something like that. So you don't return it, but there's an allowance. So net credit sales in there are 1,300,000. Now, you're asked to come up with the journal entry to adjust for bad debts, using first a balance sheet approach, which is 4% of gross receivables. That's a alternative to aging, and 2% of credit sales. So let's see what happens. In the first case, we're going to have the accounts receivable estimated, or the allowance account estimated at the 4% of the accounts receivable balance. So in here, we're saying that you've got 180,000 of accounts receivable. Target balance is 4% of 180. So the target balance in this account is 10,007. Now, as I show you up on the screen, target balance is 10,007. You have an existing debit balance in there. I'm sorry, is it 72? 72, sorry, 72. Okay, so your target balance is 72. That's the balance you have to have in the allowance account. There's an existing debit balance of 35. So the adjustment I need is 10.7. So the journal entry is going to debit the bad debt expense for 10.7 and credit the allowance for 10.7. That becomes the adjustment I need in there to reach the target balance of 72. If there was a different number in that account, I'd get a different adjustment. So if the allowance account had no balance, the adjustment would be 72. If it had a credit balance of 1,000, the adjustment would be 6,200. So again, the allowance is the primary focus. The net realizable value in this case is 172.8. The net realizable value. $172. So that is the balance sheet methodology. Last time we'll see it today. Questions on the balance sheet approach. The approach is designed to get a balance in the allowance account that gives you the net realizable value that you'd like to have for your receivables. It compromises or forces the expense. Questions on the theory, questions on the mechanics. So that's your balance sheet. Take the same set of data and we're going to move to the net credit sales approach. On this approach, we don't look at the target balance at all. The adjustment is driven by a flat percentage of net credit sales. Net credit sales are 1,300,000. We take 2% of that, and it's $26,000. The expense is the desired result, but the allowance account gets forced. So in this case, the bad debt expense is debited. The focus is %2 of net credit sales. We're not concerned with what goes on in the allowance account. 2% of net credit sales. So the journal entry debits the bad debt expense for $26,000, credits the allowance account. So the adjustment here, and you have it up on the screen, $26,000. The balance goes to 24. Did I change that debit balance in here? Wait, did I do something wrong there? I think that looks different, right? Oh, I changed the debit balance, I'm sorry. So I said as assuming you have a debit balance there of $1,750. Sorry about that. Okay, so I changed the assumption, and the adjustment is $24,250. So we weren't concerned about the debit balance that existed in that account. We make the adjustment for the full amount of the 2% of credit sales, and in this case, the net realizable value, which is the accounts receivable gross minus the allowance account, $155,750. So $155,750 is the net realizable value. We didn't care what was in that account. The main concern was the expense. So that is the percentage of sales approach. It forces the allowance account. I mean, what if the balance in here was a credit balance of $2,000? The entry would be the same. If the allowance account had a debit balance of $5,000, the entry would be the same. So the journal entry on a percentage of sales basis is not affected by the balance in the account. So in this case, we assumed that the balance has a debit balance of $1,750, and no matter what balance is in there, we're taking 2% of the credit sales. Let's do the next part of this problem. But before we do that, how we get the debit balances, let's make sure that we're set on this. So it doesn't really matter what balance is in the allowance account when you take the percentage of sales. Now, let's do an actual write-off. So let's assume now that an account with $2,000 for a specific company is now uncollectible. We're going to debit the allowance and credit the receivable. The allowance is the cushion that we use to absorb the loss. And as we said before, when you have a write-off, write-off's $2,000. When you have a write-off, the write-off will be a debit to the allowance, a credit to accounts receivable. So the accounts receivable now have a debit balance of $178. The allowance is $22,250. But the net realizable value does not change. Remember, the NRV does not change by the write-off. So the entry to write off the account is a debit to the allowance and a credit to the receiver. Debit to the allowance, credit to the receiver. That's the way you write off an account. Now, to answer your question, you could have had, in this case, just to make up some numbers for you, let's say the allowance account started this problem with a balance of $1,500. let's take this write-off. So now you make this entry. You debit the allowance, credit the receivables for 2. The balance now goes to a debit balance. So I don't necessarily have to give you a debit balance. It could pop up through the problem. You know, while you're working through the problem, you could wind up with a debit balance. So a debit balance will result when you write off more than you provide. And that could happen throughout a problem, a question. But normally you'd be given the, you know, I had the first case A, I had a balance of 35, debit, second case 1750, so that, you know, normally would be given, but not necessarily. Doesn't have to be given. All right, so any other questions on percentage of sales? All right. Now, one thing we didn't do yet is a recovery. If an account is ever recovered. So let's say you write somebody's account off, 2,000, and, you know, give you a perfect example. This company's account was sent to an attorney for collection, $2,000, so we write it off. The attorney is able to collect half. So what do? The first thing we do is we reinstate the account and restore the allowance. All right, so the first thing we do is reinstate the customer's account and restore the allowance. That helps not only get the accounts receivable back on the books, it restores credit rating for this individual. All right, so now we restore that company's credit rating with us, as well as we put the receivable back, and then we record the collection. So if there is a subsequent recovery, you reverse the allowance. So now I'm going to reverse the write-off, I should say. So in this case, I had the write-off, which we should have erased, I guess. So the write-off debited the allowance, credited the receivable. Now I've got a recovery. And the recovery is going to be $1,000 and debit to the accounts receivable and 1,000 credit to the allowance account. So we basically recovered half of that write-off. So you restore the allowance account, also restore the customer's account and the credit rating, and then you collect it. So that would be a subsequent recovery. All right, so that, again, is, I think, the complete example that we would, take you through for the allowance methods to estimate percentage of credit sales, income statement focus, balance sheet focus. Again, when you've got the balance sheet focus, you always have to turn to this calculation. This is only used for the aging and the percentage of receivables. Now, let me just show you what Hewlett-Packard does in reality, and then we've already done a lot on shifting income and things like that, and then we'll take some questions. All right, the first thing is, in this, if you look at this footnote, it will tell you, and I'm just going to read it and tell you what's in here, because in reality, companies do not simply use flat percentages. They might use them as guidelines, but the bottom line is they're going to look at specific accounts and run other metrics. So there is, first of all, it tells you they establish an allowance for doubtful accounts. They use a specific reserve for individual accounts. That's a specific review that is used when they become aware of customer circumstances such as bankruptcy filing, deterioration in operations, and so on. So as I said, we would look at specific accounts, try to find out, especially if they were 60 or 90 days past due, we would do a specific review of those companies' accounts. They maintain their debt reserves from all other customers on a variety of factors, third-party credit risk models. They'd also use quantitative measures of default probabilities, which could be a percentage of sales, financial conditions of customers. They also look at the time the receivables are due. They'll also consider economic trends, industry trends as well. So when you evaluate an allowance, you get information from the credit management of the company. You'll get information about the industry of the companies they're selling to. They'll have economic forecasts. So all of that would go into this. So the flat percentages are just guidelines, and we use them in a textbook environment. But in reality, there are many more factors that will go into the bad debt allowance.